Welcome to the inaugural broadcast of the Financial Performance Matters podcast. I'm your host, Dana Jensen, principal of Danisher Consulting. Today is my guest is longtime colleague and friend, Joe Schnied. Joe's the managing tax partner for Aldrich CPA in my hometown of Portland, Oregon. Welcome, Joe.
Thanks for having me, Dana. Good to see you.
Good to see you. Joe, congratulations on another tax season. I'm sure you've got a few clients on extension, so you're not exactly in the home stretch. Yet you've had a chance to review a few returns by now. Tell us what you're seeing differently on this year's filings than you saw a year ago.
You bet, Dana. I think that the tax returns that we've seen this year have been more complex and show more income than we've seen in prior years. And so complexity comes from IRS's rules have changed significantly. Congress has passed new tax laws. The world around us is really changing with Bitcoin and the other NFTs. And we're seeing just an increase, I think, in financial activity. At the same time, we're seeing a decrease, if you will, in the average taxpayer's ability to keep track of what he's doing or what she's doing. And so a lot of that burden ends up falling to the income tax preparer to just kind of sort out whatever is in their shoebox.
A different kind of shoebox these days.
For sure.
Interesting. Well, thanks for that.
I think that the quality, again, I think the other thing that we're seeing out there is there are incentives. There's research and development tax credits. There's energy credits. There's, moving to a new place credits, all kinds of different things that are specialty items for incentives for people to act in a certain way. And a lot of people don't know what they are. Frankly, lots of times a client will show up and ask me about something that I have to go look up.
Gotcha. Okay, well, thanks for that, Joe.
Sure.
The construction industry is an important niche for you and Aldrich. Construction is replete with lots of hardworking men and women. The reality of rising labor and material costs, along with the prospect of rising interest rates, poses kind of a gloomy outlook for construction in the next couple of years. While the possibility of an industry downturn may be months away, what advice are you providing to contractors to prepare for a potential slowdown?
Yeah, great question, Dana. I agree with you that the world is changing and we're not sure where it's going to be in a year or 2 years from now. And contractors have an awfully long lead time, right? They might be replying to an RFQ now that will lead to a bid that would lead to work that starts 6-12 months from now before they actually maybe break ground on an effort. And so as a result, having some plans in place in terms of what to expect is really important. I think number one is cash is king. Right? Don't over leverage yourself and don't borrow would be another advice. But let's go back to cash is king and your working capital first. I think when you're looking at a downturn coming, you have to be prepared to manage your work and your folks appropriately. And that means staying profitable. And that means not taking on jobs that you might think, well, this will get me through the downturn, when in fact it's a loser job, right? With all the factors that you mentioned in terms of inflationary pressures, et cetera, I think you just need to make sure that you become a little bit more conservative, maybe in the way that you approach your business model.
I think developers in real estate are going to take a hard look at projects if the cost of money doubles for them.
I agree. And I think that I'm seeing that in the marketplace today.
Wow.
That in terms of saying, hey, do we build this market rate housing project, or do we build a shopping center, and a lot of it has to do with whether or not the cash flow, the return for that developer is appropriate. We've seen really, really low cap rates lately, right? Which means that people are overspending already for real estate, expecting to get a return on investment that maybe is not where it should be traditionally. And so I think if a downturn's coming, we already have expensive real estate out there. It's going to be really difficult to envision having a substantial amount of investment in new real estate, new property.
Thanks for that. Well, regardless of what industry you're in, pricing seems to be on every business owner's mind, and no wonder. With inflation impacting producer prices for the last year or so, it was only a matter of time before it showed up in the cost of consumer goods, and it has. For those companies in a service industry like construction or healthcare or professional services and so on, how can business owners ensure their pricing stays competitive with the market and not run the risk of losing market share?
Yeah, great question. I think the first thing is you have to be able to have the skill of being able to listen to not only your customers, but your competition as well, right? We don't want to underbid any of our work, because I think that can lead to competitive is a funny word, right? When you ask about being competitive in the marketplace, I think that the issue is that competitive is not competitive if it's way underpriced and you can't do the work for what the price that you've bid. So I want to make sure that even if you're worried about inflation and you're worried about how much more you have to pay the next project manager or next general manager that you hire, that you make sure you're covering your costs. And I think that's the way you stay competitive. I think the other thing is you really need to talk to your key financial advisors, specifically your banker, your surety in the construction industry, your CPA and your financial consultant. What's going on in the marketplace? What are they seeing? And I think that, whether you belong to a trade association or you just have coffee in a coffee shop with a couple of friends that are also friendly competitors, ask the hard questions. How are you making money? What's going on? What's happening? And you'll find that the competitive world and staying competitive is really one where we all want each other to succeed. And we're not going to beat around the bush if it says the times are tough. And so I think that the communication, listening to your colleagues, listening to what's going on in the marketplace, and then applying it to your job is important. I think the other thing you have to listen to is your heart. A lot of times you'll go into the office and you just got your head down, and listen to what your heart and what your head is telling you about, do I need to hire or maybe fire a couple of people within my organization? And if you block that out and you don't listen, then I think that you can get yourself in trouble.
Today, we're meeting with Joe Schnied, Senior Tax Partner with Aldrich Advisors. Where are you going? Joe, the EV revolution is certainly taking the auto industry by storm. Now we're seeing electric trucks and vans coming to market in America. What current tax incentives should a business owner consider when replacing vehicles in their fleet this year?
Yeah, great question. First of all, you can get a credit through 2021. Hasn't been expanded yet to 2022 that I know of, but I imagine it will be, because that's the way Congress works, right? Is they keep incentive to put an electric charging station on your property. And that credit is equal to the lesser of $30,000 or 30% of the cost of putting that charging station in. And so that certainly is an incentive in terms of maybe today you've got a fueling station, you've got a big tank and you're allowing your vehicles to fill up, you're going to have to now put in an electric service as well for your electric vehicles. You'll get a credit for that. I imagine that even though the law today says no, pretty soon again it'll say yes. I think the other thing is with respect to purchases of vehicles, there's a list that's updated regularly that you can get up to $7,500 credit for purchase of an electric vehicle. Once that vehicle sells enough units, then the government stops giving us the credit. And so, for example, I own a Tesla Model S. I've had it for 7 years, and I got a $7,500 credit against my purchase price when I bought it 7 years ago. That car no longer is eligible for the credit. So depending on the manufacturer and the model, the credits can change. In addition, states offer credits separate from the federal government, and these are income tax credits for purchase of the vehicles. So I think my advice there is work with your fleet manager, do the math, but also understand your locality. And let's say you've got 3 locations. Maybe you're going to jump into your location where the credits are offered first to see how it works inside your organization before you expand that effort.
So let me ask a follow-up question about that, Joe. So if I'm a business owner and I put in a charging station and it costs $100,000,
yeah.
Okay, what you're telling me is I get a $30,000 tax credit on that $100,000 investment.
You would, yes.
What about the rest of the $70,000? Can I take a bonus depreciation or Section 179 deduction for it?
Under current tax laws, you can take bonus depreciation on that electric charging station, which means you get in 2022, you'll still get 100% of the cost deducted this year. It's a deduction, it's not a credit. So a deduction is an expense against your income, right? That leads to calculating your taxable income. A credit is an offset against the calculated tax. So credits are much more effective in incentivizing individuals to take advantage of a certain incentive.
So let me get this straight. If I'm getting bonus depreciation, I take $100,000 deduction, assuming that's what it costs, against my income taxes, against my income. And then I also get $30,000 credit to pay for my taxes?
That'd be lovely, but that's not the way it works. Instead, you'll get the $30,000 credit, Dana, and then the remaining $70,000 basically is eligible for the deduction, right? Because the government's not going to let you double dip. But frankly, that 30%, that $30,000 tax credit is worth a lot more than the $70,000 tax deduction. Let's say we're a corporation in the 21% tax bracket, right? A $70,000 deduction equals $14,500 in tax savings, right? Contrast that with a $30,000 tax savings directly that you get from the credit. So the credit's much more powerful than the deduction is.
Awesome. Thanks for explaining that. Appreciate it.
Sure.
Coming out of the 2020 pandemic, some companies, as we've discussed, may be experiencing a financial difficult situation. Capital never been cheaper than free. So for those businesses still trying to get back to making money, what advice can you offer a business who survived COVID about raising their net margins?
Well, let's define net margins first. It's your sales minus your cost of sales, right? Gives you our net margins. And I think that the important thing, my advice first is know what your cost of sales are, right? So if you're unsure and you don't have a good handle on what your costs are, then I don't think it's going to be easy to resume profitability. And in today's world, a lot of times taxpayers or small business owners, even large business owners, kind of guess at what their costs are. They estimate based on how much they think their labor costs, and they don't realize that there's all kinds of burdens associated with labor. That anytime you pay somebody for an additional hour, it might cost them a 1.5 times that in terms of the costs associated with doing the work. So I think that that's number one. Know what your costs are. Otherwise, you'll never know where you need to price your work. My second advice for struggling is you have to know what you're good at. And sometimes that means that if you're doing too many tasks, you need to drop the 1 or 2 tasks that you're not very good at and focus on the efforts that you are exceptional. Let's say that we're an excavation contractor, and it turns out that we're terrible at laying pipe. Do we know that we're terrible at laying pipe and we should just be digging the ditch, or we should just be moving dirt? If we know it or we sense it, and remember earlier we talked about listening to your heart or listening to yourself a little bit, make that decision and take away the work that deep down, as much as you might like it, isn't profitable, because otherwise you're never going to resume the profitability in your business.
Right.
So focus on your strengths, Dana. I think that that's a big part of it, but also know what your costs are to do the work.
Good call. Jim Collins talked about that hedgehog concept in his book, Good to Great. It's exactly what you're talking about. Joe,
finding here, if I might,
go ahead.
Is sometimes we can be a really good contractor or doctor or accountant and a lousy manager. Right? And I think that when you talk about struggling and working your way through the pandemic and then coming out and getting back to profitability, you have to recognize that managing your business is a process that requires you to put aside sometimes your strongest skill set, which might be being a doctor or being a contractor or being an accountant, and manage the people around you effectively. Listen to them, encourage them, help them grow and be successful, right? And their success will then turn around as a business for you as a business owner and lead to your success.
Good point. Speaking of people, finding competent people has never been harder.
For sure.
I was on the phone with a recruiter on the way to the podcast studio. And while it may be a candidate's market, business owners are well served to hire credentialed people, especially in the area of finance and accounting. For those business owners who don't have an in-house CPA or CMA or other credentialed financial manager, how can a business owner best use a professional services firm to help fill that gap and still be making smart business decisions?
Yeah. I think, Dana, the first decision is you have to be all in or not in at all with respect to asking someone to fill a gap. I think that too often the professional service provider is asked to do a couple of tasks and then they fade away because the business owner maybe doesn't understand or doesn't want to embrace the hard truth that the professional service provider is sharing with him. And I think that when you commit to ask someone like yourself or me or someone else to come in and assist your business with tax and accounting or with HR or something else, the business owner too often thinks it's just a stopgap and that they'll get back to being able to do what they used to do. And that's not the case. The best use of your professional service provider will be to embrace him or her, to welcome him in, and to expect hard truths that you're willing to execute on making better or changes because of that.
Wow. Good advice. Joe, it's always a pleasure to talk to you. Thank you for being on the show today. And special thanks to Aldrich for letting you join us. Aldrich Advisors.
Dana, I look forward to doing this again sometime soon. Thank you.
You betcha. At Janitor Consulting, we believe owning your own business is one of the best ways to create wealth in America. We work with closely held companies to drive financial performance in your business. Whether it's your first million or your next million, we can help you get there because financial performance matters. I'm your host, Dana Jensen. Thanks for joining us, and we'll see you next time because financial performance matters.